Možemo da krenemo. Dame I gospodo, poštovani predstavnici.
Ladies and gentlemen, esteemed members of the press, dear members of the Council of the Governor, dear colleagues, I wish to welcome you on behalf of the National Bank of Serbia to the May presentation of the inflation report, where we shall present the most important macroeconomic developments and our projections going forward. At the very start, I will underline several key facts with regard to the current movements and that are presented in our inflation report. First of all, April year-on-year inflation measures 15.1% as published by the Statistical Office, which is 1.1 percentage point below the March data. And this means that the inflation peak is behind us and that the monetary policy measures undertaken in the past period are yielding results. We are past the peak of not only headline but also of core inflation. That our measures are yielding results is indicated also by the stabilized 1 year ahead inflation expectations, as well as by medium-term inflation expectations of the financial sector that are kept within the bounds of the target. Our view of future inflation path has not changed since February. That is, we expect continued decline until the end of the year, and by the end of the year, inflation will be half the figure recorded in Q1 this year. This is around 8%, and inflation will continue down further in 2025, and by mid-2025, I apologize, by mid-2024, it will be within the bounds of the target tolerance band of 3 plus minus 1.5%. As for the GDP growth projection, despite a somewhat weaker result in Q1, we have not changed the projected GDP growth rate for this year of 2 to 3%. The main reasons are foreign trade movements that are outperforming all expectations and the continued high FDI inflow. The structure of projected growth is somewhat different and more favorable from the aspect of growth sustainability. We now expect a positive contribution of net exports and a positive contribution of private investment, which was not the case in our February projection. Third, owing to the mentioned robust movement in the foreign trade balance and a higher surplus in services trade, the overall balance of payments trend since the start of this year turned out to be much more favorable than expected. The current account deficit, seasonally peaking in Q1, since January until March, measured only 0.7% of GDP. It contracted owing to the lower imports of energy, primarily gas, and also the sustained high growth rate of goods and services exports, thanks to the effects of past investment and the recovery of production in the energy sector. Considering a much lower than expected current account deficit in Q1, we now expect its share in GDP this year at around 4.5% annually, which is more favorable than our February expectations. We also deem there is a great probability that this share might turn out even lower. The preserved and strengthened stability of the domestic banking sector, confirmed by the high capital adequacy of 20.5% and an NPL ratio brought down to a new historical low of 3% at end March, indicate that, in our case, there is no trade-off between price and financial stability. In other words, our measures account for the fact that Serbian inflation is mainly driven by supply-side shocks from the international environment and are calibrated so that the cost of loan repayment does not affect the quality of bank assets and NPL growth, while still containing an excessive expansion of loan demand. Finally, and perhaps most importantly, we have demonstrated high resilience to the shocks of a multidimensional crisis we have been facing for more than 3 years, as frequently underlined by all relevant international institutions and rating agencies. This is confirmed by the movement of key macroeconomic indicators. Apart from the record high FDI inflow of close to 7% of GDP annually, continuing into this year as well, the most important indicators of our resilience are also high and production diversified growth in goods and services exports, which despite reduced external demand reached 38 billion euros last year and will probably exceed 42 billion euros this year. The resilience is also confirmed by the ensured public finance sustainability and a record level of FX reserves of 21.6 billion euros in April. This is a result of the responsible economic policy of the Serbian government and the National Bank of Serbia, full coordination of monetary and fiscal policies, and the implemented structural reforms. These have been some of the main observations from our May inflation report concerning macroeconomic trends and the outlook. And now we will go through each of these statements in detail and we really looked forward to this presentation, and our material is really rich. We will start from the international environment. Although the optimism that prevailed early in the year regarding more favorable global growth prospects and the possibility of faster containing of global inflation somewhat dissipated after the recent problems in banking groups in advanced world economies, the risks can still be assessed as less pronounced than last year. These problems in international banking sectors resulted in a mild downward revision to global economic growth for this year to 2.8%, as estimated by the International Monetary Fund. Speaking of risks, it is important to note that they are much lower regarding energy supply to Europe, with the concurrent easing of global cost-push pressures, resolving of disruptions in global supply chains, and the lowering of the risks of a global recession. Apart from this, the growth outlook of the euro area, our most important trade partner, improved since the last report, primarily due to the demonstrated higher resilience to the energy crisis than expected. According to the consensus economics estimate from April, euro area economic growth for this year is projected at 0.7%, and this assumption is embedded in our new projection and represents an upward revision relative to the stagnation anticipated in the February projection. Faster than initially expected growth in the euro area should also affect positively on our exports and private investment. A further decline in world gas and electricity prices and the unwinding of supply bottlenecks resulted in headline inflation's slowdown from multi-decade highs in an increasing number of countries. However, it is still early for central banks to announce a final victory over inflation, as the indirect effects of elevated prices of energy and industrial raw materials in the past period, coupled with a strong labor market, are still driving up core inflation in a number of countries, including the euro area. For this reason, both the ECB and the Fed continued to raise their policy rates, tightening global financial conditions. However, the pace of policy rate hikes is gradually decreasing, and central banks assess that future decisions will be data-dependent. Most countries do not expect inflation to return within the target tolerance band before 2025. In the context of the impact of imported inflation on inflation in Serbia, it is important to note that it is stronger than the euro area inflation figure indicates, because even within the euro area, there is a certain degree of divergence, with inflation higher precisely in those countries with which we have the strongest ties, Germany and Italy. Inflation is also high in non-euro area EU countries, which are our important trade partners as well, such as Hungary, the Czech Republic, and Romania. Year-on-year inflation in Serbia edged down to 15.1% in April, which is consistent with our expectations. Core inflation also slowed to 11.1%. The contribution to headline inflation's decline came from all its key components, but mostly from food and energy as the main drivers of inflation in the past months. Close to two-thirds of the contribution to inflation still comes from food and energy prices, as the indirect effects of elevated production costs and high energy prices from the past period still persist. The completion of their pass-through, the anticipated further slide in primary commodity prices, and easing of global cost-push pressures ought to support the continuation of the disinflation process. With this in mind, we estimate that inflation will continue on a downward path until the end of the projection horizon, fall more sharply in the second half of the year, and return within the bounds of the target band in mid-2024, the same as we expected in our February projection. Inflation's decline will also be supported by the past tightening of monetary conditions, slowing of important inflation, and lower external demand amid the expected global growth slowdown. At its March and April meetings, the NBS lifted further its key policy rate to 6%. The aim was to contain the second-round effects of elevated cost-push pressures from the international environment in the past period on rising prices at home through inflation expectations, and to support inflation's return within the target tolerance band by mid-2024. Given that global cost-push pressures have abated further, at a meeting in May, we decided to keep the policy rate on hold. The NBS retains the option to increase the rate further, but also signals room for a further increase in the weighted average repo rate up to the level of the key policy rate, owing to the flexible monetary policy framework in place since December 2012. At the same time, by maintaining the relative stability of the exchange rate of the dinar against the euro, we contribute to the preservation of high business and investment confidence, to the containment of the effects of the spillover of rising imported prices onto prices at home, and to overall macroeconomic stability amid elevated global uncertainty. Appreciation pressures, which have been recorded since May last year and were briefly interrupted in January, have prevailed again as a result of favorable foreign trade movements and high FDI inflows, prompting the NBS to intervene in the IFM by buying over 1 billion euros net in the first 4 months. The NBS FX reserves hit a new record high of 21.6 billion euros in late April, which is well above benchmark values of all reserve adequacy metrics. At such level, FX reserves are an important buffer against the wide range of risks which may come from the international environment. The NBS's monetary tightening drove interest rates in the interbank money market further up and induced a rise in rates and dinar loans, indicating the efficiency of the transmission mechanism through the interest rate channel. Interest rates on euro-denominated loans also went up as financing conditions in the euro area were tightened further. Lending to the non-monetary sector continued to slow, to 3.7% year-on-year in March, partly as a result of the maturing of guarantee scheme loans. It is important to note that the share of NPLs in total loans fell to a new low of 3%, indicating that the increase in loan repayment costs did not affect the quality of bank assets, and that financial stability has been preserved even during the multidimensional crisis we have faced in the past 3 years. The NBS's gradual approach to hitherto monetary policy tightening reflects the fact that inflation has been led mainly by supply-side factors so far, and the NBS's intention to affect economic activity to the least extent possible, while at the same time leaving room for its further growth. According to the initial estimates of the Statistical Office, GDP rose by 0.7% year-on-year in Q1, guided by activity growth in the industry sector, primarily thanks to a rebound in electric energy system production. A positive contribution also came from the service sectors, though it was lower than in 2022. GDP growth is estimated to speed up in the remainder of the year on account of expected acceleration of activity in the euro area and our other important trade partners. As I highlighted at the beginning, GDP is expected to grow by 2 to 3% this year, the same as expected in February, but its growth structure is more favorable in terms of sustainability than in February. As euro area's growth projection for this year has been revised up and foreign trade movements in Q1 were much more favorable than anticipated, we now expect net exports to provide a positive instead of a negative contribution. Growth will continue to be led by domestic demand, notably private consumption, thanks to rising employment and wages, but private investment is also expected to make a slight positive contribution instead of neutral. Total fixed investment will thus maintain its pre-crisis share in GDP of close to 23%. Assuming a rebound of the global economy and, by extension, external demand as of the second half of 2023, and the planned implementation of investment projects, mostly in road, railway, energy and utility infrastructure, we expect the GDP growth to pick up as of 2024 to the range of 3 to 4% and resume its pre-pandemic growth trajectory of around 4% per annum thereafter. The current account deficit in Q1 measured a mere 112 million euros, or 0.7% of GDP, down by over 1.4 billion euros from the same period in 2022. Such outturn was supported by lower energy imports, largely because of reduced global energy prices, but also by continued growth in goods and services exports at high nominal and real rates. Almost all key manufacturing branches recorded export growth, with the exception of production of oil, chemicals and chemical products, and base metals, confirming our economy's resilience to weak external demand. In addition, Serbia was a net exporter of electricity in Q1, which had previously not been the case in this part of the year, thanks to a rebound in production and a mild winter. Since the first quarter current account deficit was much lower than expected, we now expect the annual share of the current account deficit in GDP this year to be considerably lower as well, measuring 4.5%. It will then continue to decline gradually to around 4% in the medium run, reflecting higher export supply on account of earlier investment and the rebound of external demand. Based on preliminary data, in the first 4 months, FDI inflow amounted to 1,259 million euros, up by 66% year-on-year. According to our estimate, net FDI inflow will continue to fully cover the current account deficit, as in the past 8 years, contributing to sustainability of our external position. We expect FDIs to remain highly geographically and project diversified and mostly directed to tradable sectors. Responsible fiscal policy plays an important role in ensuring price stability and sustainable economic growth. Fiscal policy in Serbia has been planned so as to ensure a continued narrowing of the fiscal deficit and a downward public debt trajectory in the medium run, while maintaining government capital investment at around 6 to 7% of GDP without generating further inflationary pressures. This should be supported by the adoption of new fiscal rules applied since early this year, limiting the share of public sector wages and pensions in GDP to around 10%. A lower than anticipated general government deficit in 2022 and sound fiscal performance that continued into Q1 2023 with a primary balance surplus of 23 billion dinars enable stronger growth in government capital expenditures and ensure a decline in public debt that is even faster than forecast by the revised fiscal strategy for 2023 with projections for 2024 and 2025. Ladies and gentlemen, dear colleagues, there is no doubt that the multidimensional crisis we have faced for more than 3 years now is probably the most turbulent period in recent world economic history, with strong scarring effects on the global economy. Still, it should be emphasized that our economy has so far demonstrated exceptional resilience to the unfavorable developments, with negative effects reduced to a minimum. As the main risks to the inflation and other economic movements continue to emanate from the international environment, the NBS will continue to monitor and analyze trends in the international commodity and financial markets and estimate their effect on our economy. Monetary policy decisions will depend on the incoming data about key inflation factors from the domestic and international environment, taking into account the effects of past monetary tightening and the time needed for them to play out fully. Finally, I wish to underscore that the NBS will remain committed to ensuring the welfare of the country as a whole by guiding inflation's return within the target band and leaving as much room as possible for economic growth, a rise in employment and the standard of living of all our citizens. Before I open the floor for your questions, I will now ask our colleagues to say a few words, primarily the General Manager of the Economic Statistics and Analysis Department, Savio Kovljevic. During my presentation and in our previous projections, we could see that around 2/3 of the so far impact on inflation came from energy and food prices, and these categories will contribute most to the inflation's decline going forward. Our colleague Milan Trajkovic is also with us. He will speak about energy products. Mirjana Miletić will say a few words about food prices, and finally our colleague Dragašević will say a few words about trends in the FX market and the importance for the preservation of financial stability.
Thank you, Vice Governor Jovic. We will now try to give more details and data about our latest projections of inflation, current account deficit, and GDP, and we will also make comparisons with our previous projections, given that there have been some changes. Though the actual outturns are better than expected. Here we primarily refer to the current account deficit, which exhibits good trends, and we've seen this late last year, and similar trends persisted early this year. So this is a part where we have had a major improvement relative to the February inflation report. When it comes to inflation projection. Actual inflation was in line with our expectations, and there have been no major changes here. As Vice Governor Jovic pointed out, inflation peak is behind us. It was reached in March, and the April data that he mentioned, we will have, in the coming months, we will have a gradual disinflation, and in the second half of the year, the disinflation process will step up. Inflation practically remained the same when it comes to GDP growth. We retained our previous projection in the range of 2 to 3%, but the structure of growth is somewhat more favorable. But let us start from the current account deficit, and let us explain it in more detail. We've done so before, but we want you to understand it rightly. This is the economic position of a country toward abroad. That is the balance of all outflows and inflows under current transactions. So when this balance is positive, we say that the country is in a surplus of the current account, and when it is negative, then the country is running a current account deficit. Usually developing countries that have significant energy imports and imports of raw materials, they tend to record current account deficits, but these deficits should steadily decline. The favorable foreign trade developments in the first quarter were rather favorable, and we had a current account deficit of mere 112 million euros, which is an improvement of the country's external position by 1.4 billion euros relative to the first quarter of 2022. What contributed to this most are lower energy prices, but we also have significant positive trends when it comes to exports. I will give you a few data in terms of energy. When you look at figures, in the first 3 months of 2023, energy imports were lower by around 370 million euros than in the same period last year, and most of the improvement relates to lower prices. But exports of energy are also recovering, so on this account we had an increased inflow in the amount of 260 million euros. So when these two figures add up, we get an improvement of 630 million euros in the current account deficit. The remaining amount is 800 million euros, and the bulk of it relates to the improvement of exports of goods and services. We had these trends late last year, and they continued in the first quarter of this year. Manufacturing exports increased by 12% year-on-year, while exports of services climbed by 35%. Exports of services have been rising from year to year, and we have recorded a significant improvement early this year as well. We have favorable trends on this account, and also an inflow of foreign exchange into the country, and this of course contributes to the development of our country and to GDP growth. Several factors are also important for export growth, and this is what we tend to highlight all the time, and this is the activation of numerous export capacities owing to prior foreign direct investment. Existing capacities are expanded. Like I said, export capacities have been activated, while existing capacities have been expanded. So new investments are arriving. The service sectors continue to grow at quite a brisk pace, and in the second half of the year we should see solid growth in agricultural exports too. So for these are some important factors that led us to significantly improve our current account deficit projection, because in February we expected the deficit to amount to 7% this year. Now we expect it to reach 4.5%, though there is a significant probability that it will be even lower. global uncertainty persists, but the trends that we have seen in the first quarter, the current account deficit could be even lower. To illustrate the projection of 7% of GDP, the deficit was supposed to be 4.7 billion euros, and the current projection of 4.5% of GDP is 3.1 billion euros. So this is an improvement in the balance of net outflows by 1.6 billion euros. Also, if we take a look at all figures at the level of the year, we expect exports to reach 42 billion euros compared to this is an increase of 10% from last year when exports measured 38 billion euros. And if we compare it to the pre-pandemic 2019, this is an improvement of as much as 80%. We devoted more attention to this because we have very positive trends here, and that is why we now have a more favorable structure of GDP growth, because this component of net exports is now giving a greater contribution, and it shows more stable movements, so it is more likely that our projection will come true. In the first quarter, we had GDP growth of 0.7% year-on-year. This is somewhat lower than what we expected in February, but we expect GDP growth to step up to 1.5 to 2% in the second quarter, and in the second half of the year to reach 3 to 4%, partly also on account of the lower base in the second half of last year. But we also expect a recovery in the sector of construction. The risks to GDP growth projection are judged to be symmetric, and they mostly come from the international environment. When it comes to domestic risks, it can be said that the only major risk comes from agricultural season. But based on developments so far, it seems that the season will be good. But of course, we are cautious because we don't know what is going to happen during the summer months, whether there will be drought or not. And we decided to be cautious. We have assumed that the season will be better than last year's, but below 10-year average. We see some upside risks here because the movements so far indicate that our expectations could be easily outperformed. And when it comes to inflation, Vice Governor Jovic already said that he already explained the key factors behind the disinflation process, but I would like to compare this projection with the February one. Essentially, this projection is unchanged from the previous two projections made 3 and 6 months ago, because we basically refer to the same inflation trajectory, which is downward. Some minor deviations relative to the November report refer to a somewhat lower inflation outcome late last year, whereas in Q1 2023 it was slightly higher than expected. But this decline in April and the further inflation profile is the same as in the previous two projections. So we expect inflation to decline more sharply in the second half of the year. That would this decline would persist in 2024, and inflation would return within the target tolerance band in mid-2024. The key factors behind such inflation profile are monetary policy measures, both monetary policy measures of the MBS and the European Central Bank. Why the measures of the European Central Bank? Because this affects imported inflation, which we also expect will start declining. We also embedded in the projection somewhat lower prices of oil, global food prices and global oil prices, but we were also cautious. We factored in a more persistent core inflation of in the euro area because we see that it tends to decline at a slower pace than expected by the ECB, and this is something that we have factored in our projections, because maybe our inflation would decline faster, but we took into account core inflation in the euro area. Cost push pressures are subsiding. Lending growth is slowing down. Lending growth was necessary for inflation, and this was needed in order to secure inflation's downward trajectory. Personal consumption is rising at a somewhat slower pace than total GDP, and these are all factors that contribute to inflation's decline. In the first quarter, general government deficit amounted to mere 1.4% of GDP. Fiscal policy was restrictive in Q1. So these are the most important details regarding our latest projections. I tried to compare the new projection with the February projection. You see that there are no major differences, and that the GDP outcome is much better than what we expected. Milan will give you more detail about energy prices.
Thank you. I will be very brief. So we have talked a lot about the energy sector and the impact of energy on inflation. So why inflation in Serbia started slowing later than in the euro area. And the energy sector also has an impact on the energy balance and economic growth. I will tell you a few words about the key issues. When it comes to inflation, the prices of gas and electricity are important, and Serbia started increasing them more significantly this year, and this is why inflation started slowing later than in most countries of the euro area. So last year, many countries started increasing energy prices several times. Serbia's commitment was not to do that to such an extent last year, so as not to instill uncertainty among households and the corporate sector, which has been hit by an increase in costs in general. And this explains the difference in the dynamics of inflation between the euro area and Serbia. Much better performance in the energy sector contributed to the improvement of the current account deficit as well. And as you already heard, last year in the first quarter we had a very high current account deficit of 1.5 billion euros, and in the first quarter of this year our deficit is only around 100 million euros, which is exceptionally low, especially for the first quarter. So this improvement is 1.4 billion, and around 400 refers to energy imports. And net services went up by around 300, and different manufacturing branches went up by around 100 million. And we are also now exporting electricity in net terms. In Q1 last year, we were importing electricity of 370 million euros, and in Q1 we are exporting it in the amount of around 140 million, which is better by 500 million euros. The increase in electricity production contributed to the increase in the current account deficit of 0.7%, which is the preliminary estimate in Q1. That is around half can be attributed to rising electricity production. As for more details, please take a look at our text box, and we believe it will be a good supplement to the financial report of the electric power company that was published several days ago. Given that inflation in Serbia was determined mainly by rising food prices, and that still around a half of year-on-year inflation, is owed to food prices. In this report, we focused on the dynamics of food prices, the factors behind that, and we also gave the projection of their movement going forward. It is evident that the increase in food prices in Serbia and other countries was led by global cost-push pressures, that is, rising prices of energy, oil, petroleum products, natural gas, the rising prices of primary agricultural commodities, which peaked after the Ukraine conflict erupted, because both Ukraine and Russia are important world exporters of grain, and there is also the risk as to how agriculture will unfold in Ukraine and how transportation will unfold via Black Sea ports. Packaging prices also went up. Oil has an important share in that. The prices of other raw materials went up, as well as mineral fertilizers, and we also have natural gas as one of the key inputs in production. All these cost-push pressures impacted the increase in food prices in the world. And as for the FAO index, in March 2022, it reached its peak that was close to 70% higher than after the outbreak of the pandemic, when food prices were at a minimum. After that, the world food prices were going down, but they're still somewhat higher by 20% than in the period from 2012 to 2020, when we faced no significant shocks when it comes to food prices. The prices of primary agricultural commodities followed a similar path, mainly grains, that is the prices of corn and wheat in the world market. In March and April last year reached a level that was around 50, that is 70% higher than 1 year before. From October, these prices have been declining as well, and as of April, global corn prices are lower by around 30%, and global wheat prices by as much as 40%. The increase in these global cost-push pressures spilled over to producer prices in the domestic market, the prices of producers of primary agricultural commodities, and the prices of producers in the industry, that is of food products. And currently, these growth rates of producer prices are around 20%. A higher producer price spilled over to food prices in consumption, and food prices are specific because demand is less price elastic compared to other product groups, and spillover goes much more smoothly from producer to consumer prices. In March, for instance, consumer prices of food in Serbia measured around 25%, but it should be noted that other countries recorded similar dynamics, other countries in the region, as seen in this slide. In Bulgaria, for instance, Romania, Macedonia, the Czech Republic, Poland, even Germany, Slovakia. All these countries saw year-on-year movement of these prices between 20 and 28%, and in Hungary this growth was even close to 45% year-on-year. Furthermore, we also faced a drought last year, and the region faced it as well, which impacted the rise in vegetable prices because supply contracted, and the prices of vegetables in March were higher year-on-year by around 30%, and since the start of the year they have gone up by 25%. It is usual for the season that vegetable prices go up in the first quarter, and seasonally adjusted we take an average in the last 3 years or 5 or 10 years, and this growth is around 15% due to last year's drought, but this year it was even higher. And very similar vegetable growth rates were recorded in other countries in the region as well. The weakening of global cost push pressures should also reflect on a decline in food prices. We expect that this pass-through effect of earlier high cost push pressures, we expect it to be completed, and soon food prices should strike a downward path, which happened in April, and all inflation components contributed to lower April inflation compared to March, but food prices were the main contributor. The year-on-year rate fell from 25% to 23%, and they contributed around 0.7 percentage points to lower inflation by around 0.7 percentage points, and there was also a contribution of unprocessed food, but also the prices of the contribution of processed food also had a significant contribution. The weakening of cost push pressures should also affect the downward trajectory of food prices. Within a period of 1 year, food prices, excluding fruits and vegetables, will reduce their contribution to inflation by around 5 and 5.5 percentage points, and additional contribution should also come from the prices of fruits and vegetables, assuming that this year's season will be better than the previous one, but it is still below average, and fruits and vegetables should also contribute to lower inflation by around 2 percentage points. And if this assumption materializes, the prices of fruits and vegetables by the end of this year and early next year in year-on-year terms should enter negative territory. That is, they should make a negative contribution to headline inflation. And once more, the weakening of global cost push pressures and the resulting decline in the contribution of food prices, along with the effects of the past monetary policy tightening, the slowdown in imported inflation and lower external demand should be the key factors contributing to inflation's return within the target tolerance band by the mid next year.
We can now move to the second part of the conference. We will be happy to answer any of your questions. Good day, Branislav Urošević, Bloomberg Adria. You said that you might respond again by tightening monetary policy. What are the chances of such a move? And if you do respond, do you think that you will increase the key policy rate, or whether that you will adjust the repo rate? You already saw in some of our previous decisions that we first started by decreasing the rate of the increase. We had mild increases of 25 basis points. And then in the last meeting, based on incoming data, where we saw the effects of our past measures, we saw the weakening of cost push pressures, and we know that over a horizon of 12 coming months, we see that these rate hikes will lead to lower inflation. Of course, as you said, in addition to the key policy rate, we can also adjust monetary conditions by adjusting the reverse repo rate, which we implement on Wednesdays. And should the need arise, there is room for doing so. In the last auction, so we can respond by this instrument if the need arises. And if the need arises, we can also change the key policy rate. What I can tell you now about our assumptions and about our projections based on available data, for the time being, we do not see any need for future rate hikes, but we will consider that possibility based on incoming data in the future. So you see no need for raising the key policy rate based on the current data, and you will consider this possibility for any future data. If a future data, this is a medium-term projection. The risks are balanced, they're symmetric, both to the upside and to the downside, and should there be any changes, and we cannot know this now, for instance, should there be any changes in energy prices at global level, or should there be any changes when it comes to agricultural production, we will consider incoming data and in accordance with them make a decision. For the time being, we can add that the objectives of the National Bank of Serbia are achieving and delivering price stability. If we can achieve this objective at this level of the key policy rate and ensure inflation decline, you know that our secondary objective is financial stability. You know that any major increase in the key policy rate will pass through to lending rates, the rates on dinar loans. These are most sensitive loans, and we seek not to make any damage in this respect. So we are committed to our price stability objectives. Then we review our objectives of financial stability and support to the government's economic policy, because higher interest rates lead to a slower lending growth. And here we want to have results in this respect as well.
Jasmina Dobranovic, Nova Television. Can you say something so that we can easily understand you, because statistics are one thing and real life is another thing. What about your forecasts going forward when it comes to prices in general, interest rates and inflation? So what should citizens hope for? Will they live a better life, or you predict a different scenario? Thank you. As we told you, the CPI is a uniform measure which measures the movement of prices for all groups that are covered by the index, and this measure shows that it will go down in the coming period until the end of this year, and inflation will enter the target by mid-2024. Whether a subjective feeling of people is different because they buy the same amount or a different amount of the same or different products, this is possible. But we are talking now about general and universal measures, and we expect that already with this decline in the coming period, through declines of all groups of products. Our colleague mentioned that currently 0.7 percentage points, or 1 percentage point, which was a decline in. You know that food prices declined by this amount, and you know that food is very important for each individual household, and we expect a new 2 percentage points going forward. The effect in the coming period, the effect of a decline will be visible and palpable, and we also have to take into account those who are using loans, and we have shown this through by deciding to keep the key policy rate at 6%. Perhaps our colleagues could say a few words as well.
Yes, you answered most of the questions, but when we say that we are talking about the year-on-year rate of inflation, this is, these are the prices in a current month relative to the same month of the previous year. So What does it mean when we say that we expect year-on-year inflation to decline? It means that there will be a rise in prices, but this rise will be lower. When it comes to food prices, if the agricultural season turns out better than last year's, these prices should start declining at monthly level. But for the time being, food price growth will decrease. If we take a look at the monthly level, from one month to the next, if some prices increased by 1%, next month we expect them to increase by 0.5%. This is the downward inflation trajectory. I can give you figures from the beginning of the year so that you can see what this actually means. If we're talking about food price growth, in the whole of Europe they have been rising since the start of the year, and the cumulative growth amounted to 4 to 7%. So everywhere food prices are rising, somewhere more, somewhere less. The differences since the start of the year are even lower. All countries in the region have a similar food price growth, around 6%. We should still not expect prices to decline relative to the previous month, but the very fact that the growth is lower, the year-on-year inflation will decline, and as we leave the 12-month period included in the calculation of the year-on-year inflation rate, the base effect will wane, and on this account inflation will fall. If the agricultural season turns out better, then month-on-month inflation could also decline. I told you that I want you to tell me in simple words. Can you tell me what is the price of one egg now and what it was last year? The citizens are not interested in the situation in the world or in the region. The citizens want to know what they can hope for going forward. I don't know whether you're aware of the strike, of the protest of agricultural producers. Yes, we are aware, and we keep a close eye on agriculture. If agricultural season turns out average, what we can expect then from July and August, we will see this, the effect of such a season on food prices. We will see month-on-month decline in August and September, depending on the corn, wheat and soybean crops. For instance, 1 liter of sunflower oil, it matters whether sunflower costs 60, 40 or 50 dinars. If their prices decline faster, then food prices will decline faster as well. All these risks are incorporated in our upside scenarios. Drought could happen again, so this risk is present. We had 2 consecutive weak agricultural seasons. We had drought for 2 consecutive years in 2021 and in 2022, and this never happened before. So we had an agricultural downturn of 8%. And this happened not only in Serbia, but in all countries in the region. Wheat prices cannot differ much in the Novi Sad commodity exchange or from stock exchanges in the Black Sea region or in France. These prices pass through immediately. If a producer of any of these products cannot sell the product in the country, they will sell it abroad, and that is how prices spill over. So the situation is not great, but we think that it will steadily improve.
When do you expect that the ECB will slow down the hikes in its key rates? It is important because of housing loans and because of imported inflation in Serbia. You say it is 2/3. Mr. Savio Kovljević said that core inflation in the euro area is persistent. And in light of this, when the ECB will slow down its hikes? as you had the chance to hear today. So core inflation at the level of the EU, that is the euro area, is more resistant, more persistent, and the ECB continued to hike the key rate in May by 25 percentage points. But in the case of the ECB as well, we have seen a decline in the growth rate, which can be a signal effect for us who are carefully following the developments, both for the sake of trade relations and the significant part of the loan portfolio that we have in euros in our country. And I'm talking about housing loans primarily, which are over 90% in euros, and the movement of this interest rate impacts Euribor as the benchmark rate that is incorporated in loans. So this is very important for us. So we will see, we will continue to monitor these developments, but given this hint at a decline in the rate, we can talk about the coming of the moment. We don't know when this will happen, when the ECB will stop with the increases, but we can say that the ECB somewhat later than other central banks, the ECB started increasing its key rate somewhat later. So as for the expectation, Željko said that we cannot, so the market participants can only make guesses as to when the ECB will stop increasing its rate. But given all the current developments, this moment is getting closer. As for core inflation that you mentioned and that I also spoke about, this factor is something that called for caution when we were making our projections. So what we saw in the market and a decline in cost-push pressures, the energy prices, oil prices compared to the previous period, the prices of primary agricultural commodities at the first place. So these cost inputs, given these cost inputs, our projection could also be lower, but we remained cautious because core inflation in euro area is declining somewhat more slowly than the ECB expected, and this is a group of products which we are importing a lot, and this group of products can impact imported inflation. So this part of inflation may decline more slowly. We have energy and food and other factors, but we were also cautious in terms of the movement of our core inflation, and we embedded this factor as higher persistency. So citizens can understand us. I will be more simple. So a slower decline in this group of products that are incorporated in core inflation, and in euro area, and euro area prices can of course affect our prices when it comes to imported products.
Miloš Obradović, danas. Do you have any predictions in terms of core inflation in June? You said you expected to amount to 14%, unless I'm mistaken. No, you didn't. Oh, I misunderstood it. You said headline, but do you have any predictions regarding core inflation? And the second question, you expect private sector investment to increase, and at the same time we have lending slowdown. Where will these investments come from? When it comes to June inflation, we expect it to amount to 14%, maybe slightly below 14%, whereas core inflation is expected at the level of 11%. As for investment, yes, lending activity is slowing down, but it is still rising, so its growth is slower. FDI inflows remain high. They're by around 60 to 70% better in the first 4 months of the year than in the same period last year. What's also favorable is the high corporate profit tax, which means that the corporate sector operated with positive results last year, and maybe this is an even greater source of investments than lending activity. So these are the key factors. This is also visible in the foreign exchange market. Colleague Dragašević will tell you how does this affect the foreign exchange market and foreign exchange reserves. Thank you, Vice Governor. Everything that happens in the country's balance of payments is reflected on the local FX market. The characteristics of the local, the features of the local FX market in the past 10 years is stability. Ever since fiscal consolidation was completed and when the economy was set on a sound footing and when it started growing, ever since then we have faced stronger pressures on the strengthening of the domestic currency than on the weakening of the domestic currency. For this reason, since 2017, so in 6 out of 7 years, the National Bank of Serbia has been a net buyer of foreign exchange in the total amount of 6.3 billion euros. We are net buyers this year as well in the amount of 140 million, including data for May. So if we take into account all balance of payments trends and foreign direct investment inflow, they all reflect on the foreign exchange market. We are dependent on a large number of small projects, and then the risk is if these projects are halted, the flows may reverse. Foreign direct investments are diversified and our exports are diversified too. They're diversified by economic sectors, they're diversified by geography and by product. So this diversification underpins the sustainability of these trends. When it comes to overall factors in the foreign exchange market, we had increased demand of energy importers in the first quarter due to lower energy prices and due to the lower volume of imports. Net purchase of energy importers was around 1 billion euros in the first quarter. We're talking about NIS, EPS and Srbijagas, and this is by 20% lower than in the previous 5 quarters. So when the energy crisis started in Q1 last year, so we see an improvement, and what also matters is that all other residents, the corporate sector, are stable as a result of increased exports and FDI inflows. So this supply fully offset the demand of energy importers. We also had robust inflows from tourism and remittances, and news were published over the past several days about the factors that affected demand and supply in the market. So after the National Bank of Serbia, in the turbulent period following the outbreak of the conflict in Ukraine and the entire March and February, the MBS intervened on the sales side. From May last year, we bought more than 4 billion euros. This is reflected in increased FX reserves. I will give you data for the last 3 years. So 2021, 2022 and 2023, foreign exchange reserves have been boosted by 8 billion euros. Vice Governor Jovic mentioned that they exceeded the level of 21.6 billion, and they represent a solid buffer against any potential negative shocks from the international environment. If you want to know more details about this, we are here to answer any of your questions, of course.
Marija Miladinović RTS Dnevnik. Does the NBS have information about how much we earn from the export of raw materials and finished goods when we talk about semi-finished goods, because these are huge contributors to the GDP. So you can talk in percentage terms or in value terms. Can you send this question, please, by email, and we will give you precise data. Thank you. But some general idea, yeah, we would like to have more final goods, but we don't wish to give you any imprecise information. We like to be really careful when we speak about data, because we don't want to give any imprecise data. As for services exports, they're above 11 billion. Manufacturing exports over 22, 23 billion. Total exports of goods and services last year equaled 38 billion euros, and this year it will not be below 42 billion euros. We will submit to you precise data. Jovana Rabrenovic, Politica Daily. Since the 1st of May, electricity and gas prices went up, and what is the contribution to inflation? People are very skeptical when it comes to the inflation's decline. They say the increase is around 10%, and everybody has some doubts. So I will tell you the following. So each price increase that we are aware of, and all these price increases are embedded in our projections. As for the expectations, that is when it comes to the decline in inflation, so these price increases have been incorporated in our projections, and our colleague will tell you what is the contribution in this category. Something else as well. So we embedded all the increases that we can perceive and that may not materialize at all. So this inflation projection that we presented is the baseline scenario. We also have the alternative scenario, downward and upward scenario. In this baseline scenario, we took into account everything that is on the table, and these price hikes may not materialize, and energy prices may not go up either. So the inflation path includes all the available information. So this is very important. The direct effect of price increases of January equals around 0.4 percentage points. The indirect effect is as much as that amount. As for May, it will be around 0.45 percentage points. And as for indirect effect, it will be as much as this amount. So these increases were communicated late last year. So the Serbian government, you also have this in the arrangement with the IMF. So there was communication that the increase will take place in January and May, and that some other additional increases will take place later. So perhaps the business sector already incorporated in advance these price increases already now. So perhaps indirect effects will not be will not be stronger, and if there are any future increases, perhaps the effects will not materialize. As for the daily level in May, for example, the prices of processed food, where you can expect the direct effect most, they do not increase at all, or they increased only by a small amount. So we have
the conservative
projection.
Our readers are concerned about inflation growth. That is why I asked this question. Then are we looking at month-on-month inflation or year-on-year inflation? That is the question. We understand the citizens, of course, because they had bad experiences of the 1990s, and we tend to fear price increases. But we always stand behind our conservative assumptions and projections. Are there any other questions? I would like to use this opportunity to thank you. Thank you for your attention.